Our next guest says last week's sell-off was very likely overdone, but he expects continued volatility and will be watching this week's economic data closely. He's David Spika, Chief Market Strategist at Turtle Creek Wealth Advisors. So last week, David, nothing really to get terribly excited about, a little bit overdone, you say?
Yeah, I think the yen carry trade was a big part of it, Tyler, which I'm sure you've talked about ad nauseum at this point. But when you look at where the economy is today, unemployment is still very strong at just over 4%. Wage growth is growing at just under 4%. The Atlanta Fed is estimating third quarter GDP of 2.5%. And let's don't forget earnings, Tyler. Earnings growth came in double digits for the second quarter. But importantly, the non-Mag 7 companies produced the best earnings growth they've done since the fourth quarter of 2022. And that's one of the things we've been worried about, is we needed to see that broadening out. We're seeing that now. So that gives us confidence that there's room to run here.
And yet there has been some earnings caution, hasn't there, David, in some of the commentary of some big companies?
Yeah, there absolutely has, Tyler. And think of where we are in the cycle. I mean, the Fed last raised rates over a year ago. So we're really starting to feel these rate hikes. But one of the things you need to do in this part of the cycle is look for companies that have visible revenue and earnings growth. A lot of the commentary was around cost cutting and AI capital expenditures slowing down projected AI growth. But there's still plenty of good companies out there. And like I said, you're seeing good earnings growth and good revenue growth out of the non-Mag 7. And I think investors need to start being a little more particular about where they're putting their money. We can't just throw it all at the Mag 7. We need to look for other opportunities in the market, the values, the cyclicals, the small caps. And it was good to see those companies start to outperform the Mag 7 even before this most recent downturn.
Let's presume that the Fed does cut interest rates. We'll learn a little more when they go to Jackson Hole, I suppose, in terms of context. But let's assume the Fed cuts rates a month from now. Is that probability all but already priced into stocks? In other words, would you expect to see certain subgroups of stocks or stocks generally go higher on a rate cut, or is it all sort of already in the numbers?
That's a really good question, Tyler. I would say 25 basis points probably is priced in, and you're going to see home builders and consumer stocks and certain companies do better on a rate cut, banks, financials. The one thing we don't want to see is we don't want to see the Fed overreact and cut 50 basis points, because that would indicate that they're panicking, that they believe they're behind the curve. And I think the market would take that negatively. So let's stay the course. Jackson Hole probably won't tell us a whole lot. We're going to get CPI this week. We're going to get August employment report in early September. And these are things that we need to be looking at. But 25 basis points is probably priced in. And quite honestly, we think that's probably the best case right now. And that puts us on that rate cutting cycle, which eventually gets us to the neutral rate for the Fed, which over time is probably around 3%.